Congratulations, newbies, for completing Basic Series number 1. And welcome to part 2 of Trading Basics. In this series, we will expand on what you already learned in part 1, and we'll introduce to you a few more useful concepts, tools, and techniques so that you can be more successful in your everyday trading. In the last lecture, we finished Basic Part 1 with a discussion on volatility. In this video, we'll explain the concept of margin call. As we mentioned earlier, when you open a margin account, banks give you more buying power than you actually have. That is, more money than your deposit in the account. Although this depends on the stock you buy. For instance, if you buy shares of a reputable strong company, usually brokerage gives you more leverage compared to a local small company. This is because broker finds stronger companies, such as Apple, more reliable, and it assumes that these companies will not go bankrupt overnight, so the risks of losing their money is relatively lower. For example, say you want to buy 100 Apple shares that's worth $200 each. You will need a total of $20,000, but you only have $8,000 in your account. In the margin account, your broker says your margin requirement for buying the $20,000 is $7,000. This means they will give you a leverage or a loan of $13,000. With this, you can actually purchase 100 Apple shares that's worth $20,000. Brokers sometimes use different methodologies. Sometimes they will say that your buying power is $20,000 even if you only have $8,000 in your account. This is the same thing that we explained just now. So why would banks do that? The number one reason is that they charge you interest. Depending on the country you live in, this rate varies. The rate of borrowing money is usually the prime rate plus the variable rate. The prime rate varies from country to country. The variable rate varies from broker to broker. For instance, if you were borrowing $1,000 and the bank charged you 7.2% per year, then for every day for this $1,000 that you borrow, you will need to pay $1,000 times 7.2% divided by the total numbers of days in a year, and this equals to $0.2 per day. The second reason is if you have more money, you are encouraged to buy more and make more transactions. More transaction means more commission going to the pocket of the broker. Like anything in trading, leverage is a double-edged sword. If you do a great job in analyzing the market and following simple instruction that's universally approved, then of course you can make potentially tons of profit. For instance, if you deposit $100,000 with the leverage or buying power that a bank gives you, you can potentially buy up to $400,000 worth of stocks. But if you made a mistake in reading the market or your stock position began to go down after your purchase, then trouble starts to creep in. Therefore, we need to be very careful in using margin account. Let's take a look at an example to compare the difference between with leverage and without leverage in terms of risks. Say you want to buy 100 shares of Apple, but you only have $8,000. With this amount, you can only purchase 40 shares. In a margin account, the broker says your buying power or your margin requirement to buy the $20,000 of Apple share is only $7,000. So with this $7,000 deposit, you can buy 100 shares. However, if Apple shares drops by $20, in the first scenario, you will only lose $800. However, in your margin account, this will manifest or increase to $2,000. So now, not only are you paying interest to the bank, you are also behind $2,000. This will bring down your initial investment from $7,000 to $5,000, which is a 29% unrealized loss. In the last example, we use the term unrealized loss. So what's the definition of realized and unrealized loss or gain? Realized loss or gain is the money that you get or lose when closing your positions, and this is usually irreversible. Unrealized loss, on the other hand, is the potential gain or loss in keeping your positions. In the last example, if Apple share drops $20, and when you sell them or close those positions, you will have a realized loss of $2,000. That is $2,000 gone. However, if you decide to keep the shares in hopes of Apple shares goes back up, you will have an unrealized loss of $2,000. That is, there's still a chance that your money will be recovered because Apple share can still go up. Let's examine a more extreme scenario using the same Apple share example. If Apple shares actually falls from $200 each down to $120, that is $80 in total, your unrealized loss will be 100 shares times $80 each equals to $8,000. This equals to your entire initial capital. This, of course, will scare the broker so bad that they would go ahead and sell your Apple shares without your permission in order to save their money, and they have the right to do so. No matter how much you argue with them, asking them to hold off because you think Apple shares can go back up, they would not care and they will liquidate your position. In this case, you will be left with basically nothing. This is called a margin call. We must watch out for margin calls when utilizing margin account to trade. In summary, we need to understand the potential gain and risk associated with margin account. Getting leverage from brokers could be good and bad, and we need to know how to use our leverage wisely. At Market Newbies, we recommend that you do not use your 100% buying power, even if you're almost sure of the uptick of stock price. The basic rule of thumb is to use only 50% of your buying power at any given time and keep the rest intact. Coming up next, we'll discuss quarterly reports. Thank you guys for completing this video of Basic Series 2. If you want to find more educational materials, visit www.marketnewbie.com and also follow us on Facebook and Instagram. See you in the next lecture.